So if you're new to investing or just interested in getting into it, then it will be helpful to develop a general understanding about stocks and how they work. Today we're going to walk through a high-level overview of stocks to help you better understand what they are, how they work, and why they are such an important piece of a personal financial plan. So put succinctly, a stock is a portion of ownership in a company. When a company is starting out, it's not unusual for its leaders to have ambitions and plans that outpace the company's available capital. Now, if a company has an idea or a product that sounds promising to investors, then selling stock can be a helpful way to obtain large amounts of cash quickly. So think of guys like Steve Jobs, Bill Gates, or Elon Musk, who all have or had revolutionary ideas, but they needed capital to get their businesses going. In the case of these three guys, selling stock in Apple, Microsoft, or Tesla provided a path to raise money to make their dreams a reality. Now, once shares are sold by a company, those shares become the property of the person who buys them. So as a result, shareholders can buy and sell their shares of a stock, much like anyone can buy or sell their houses or cars or any other items of value. And rarely do shareholders end up selling their stock back to the company that actually issued the stock. In fact, they probably didn't buy it directly from that company in the first place. Instead, most of the time, shares of stock are bought and sold to other individuals or institutions who want to invest in that company. The stock buying and selling process is facilitated by a stock exchange like the New York Stock Exchange or the NASDAQ. Those stocks can also be purchased over the counter through transactions. However, in order to have access to trade on an exchange, you have to be a licensed broker. Obviously, most of us are not licensed brokers, so we have to trade through someone who is. Normally, these individuals work for a larger investment company or brokerage house. And I'm sure you're familiar with some of the larger, more popular brokerages like Fidelity, Vanguard, Charles Schwab, Merrill, JP Morgan, etc. And there are many ways brokerages benefit from facilitating the buying and selling of stocks through a variety of potential fees and commissions they charge to their investing customers. Now, these fees were much higher in the past, but the good news is technology has greatly reduced the cost and complexity of buying and selling, which has made stock ownership far more accessible to the general public. So why should you buy stocks? You're probably watching this because you've either heard or know from experience that people buy and sell stocks to make money. But why do they buy and sell stocks? Why not invest in other things? Well, this is a bit of a generalization, but the primary reason people choose to trade stocks is because the combination of appreciation in the value of a stock, along with their simplicity to own and hold, makes them an attractive investment option. The appreciation piece should be quite clear. You buy stock in a company, the company generates earnings, the stock price increases or pays a dividend or both, and the stockholders are better off for it. The ease of ownership part isn't quite as obvious, but when you compare it to other assets, it makes a bit more sense. So think a minute about other appreciating assets and some of the headaches that come along with owning them. So for example, think about gold. Gold does generally appreciate in value, but you have to keep it somewhere while you own it. And liquidating gold is not as easy as selling stocks or other assets. Or what if you bought real estate as an investment? The returns in real estate can be really excellent, but you have to maintain a property, and real estate takes time to sell. Not to mention the potential tax, risk, and legal headaches that often come with owning a property. Stocks are highly liquid, meaning you can sell them almost instantly on an exchange, and furthermore, stocks primarily exist in electronic form only. So there's nothing to store, keep safe from theft, or some other sort of casualty. In addition to all that, the federal government provides a significant level of oversight in stock markets that mostly protects investors from being victimized by companies or individuals selling shares. Are there higher gains than stocks elsewhere? Potentially, yes. Are chasing those gains worth the hassle that may come with them? Maybe. That's up to you to decide as an investor. Millions of investors have decided that stocks are at least one way they want to invest their money. In fact, the S&P 500, which is basically a large cap index, has averaged a return of 10.67% annually since its inception in 1957. The total U.S. stock market has returned around 8.6% annually. Those are really solid returns for an investment that requires so little effort and trouble to own. So we've covered what a stock is, we've covered why you might want to own stocks. Now let's talk about where you can buy stocks. Now I mentioned before that stocks are bought and sold on exchanges, and access to those exchanges is limited to those with a license. For normal buyers like you and me, we'll have to go through a broker in order to access stocks. The good news is these days that's easier than ever because you can just use the internet to log onto a brokerage, set up an account, order, buy, and sell trades, all those sorts of things. Now currently, according to FINRA, there are about 3,300 registered broker-dealers in the United States. And most commonly, investors will use a large brokerage like those I mentioned earlier that have established websites, they have big names, they're actually typically easier to use. This isn't meant to serve as an advertisement for those brokerages, but you should at least use one that has a platform that's accessible, and the internet is just a logical place to do that. Another positive about using larger brokerages is they typically don't charge large fees for trading stocks anymore, or at least not if you have a certain amount of money invested through them. There's a lot of healthy competition. There's a lot of advancements in technology that have made that cheaper. But generally speaking, the more complex you get with your trading, the more you're going to run into fees. If you're planning on just buying domestic stocks, bonds, or mutual funds and ETFs, then your fees will probably be pretty low. And opening an account at a brokerage is typically very easy. You'll need a link to a checking or savings account so you can actually fund your brokerage account. Once you have the money in the account, you'll be able to buy, sell, and trade nearly any registered stock that there is. So which stock should you buy? Well, to begin, you need to understand there are risks associated with investing in stocks. You can lose some or all of your investment if you're not careful. The prices of stocks are pretty volatile, and they can go up or down for a litany of reasons. There's political risk, market risk, business risk, inflationary risk, interest rate risk, risk of default, liquidity risk, currency risk, equity risk, concentration risk. There's all these risks that drive the prices of stocks up and down as basically conditions change in the market. And unfortunately, the impact of these risks to the value of a stock is completely unpredictable, which is why I don't recommend buying and selling individual stocks. Instead, I'd suggest that you invest in a large group or basket of stocks at one time by purchasing either a mutual fund or an exchange-traded fund or ETF. Mutual funds and ETFs buy up a broad basket of stocks or other securities, and they consolidate them into a single investment, allowing you to potentially capture broad market diversification in one single investment. Also, mutual funds and ETFs are managed so they support a stated investment strategy. That could be something like de-risking a portfolio over time as you approach a particular retirement date. Target date funds do that. If you're aiming to invest in a particular industry or commodity or market sector or maybe a country, there are funds and ETFs that do that. You could get access to alternative investments like real estate or cryptocurrencies. Some offer low expense funds by basically following market indices. Those are called index funds. Some stocks focus on large cap companies. Some focus on small cap companies. Some focus on rapid growth. Some focus on value. Some focus on stability. There's a wide variety. Actually selecting the mutual fund or ETF that fits you will actually require some research. But if you want a quick and easy way to just set it and forget it, you can start with index target date retirement funds. They're cheap, low expense funds, and they basically adjust as you approach a certain date from a less conservative to more conservative asset allocation to support a given retirement. But for tax reasons, I don't recommend actually owning target date funds inside of a taxable brokerage account. Keep those inside of a retirement account like an IRA, 401k, 457, 403b, something like that. And that actually brings me to another point, which is to consider what account you're actually buying the stocks in. Tax advantage retirement accounts like IRAs, 401ks, 403bs, 457s, HSAs, and TSPs all enjoy tax benefits that you can't get in a taxable brokerage account. So if you're investing for your retirement, you can't beat the tax benefits these accounts provide, so you should start with them. I recommend reading through the Next Dollar Roadmap. I'll put a link to it above. It's a step-by-step process of going from zero or negative net worth all the way to financial independence. And there you'll find a more comprehensive explanation about how you should use tax advantage retirement accounts as a boost to your net worth. Another consideration is that I don't recommend buying stocks at all if you plan to use the money within the next 5 to 7 years. The reason is there's a chance you could invest it at a particularly bad time, leaving you with the option of either waiting years for your investment to recover or having to sell it at a loss. So if you're looking to invest for 5 years or less in the future, look at cash equivalents or money market accounts, CDs, short-term bonds, things like that, depending on what the interest rates are at the time and the shape of the bond curve or yield curve whenever you actually make your investment. Now, the odds of these investments outperforming stocks is pretty low, but you're also less likely to lose money in the short term by investing in these more conservative, less volatile investments. Now, in summary, I wanted this to be a quick overview of stocks, and I feel like we've covered a lot in a pretty short amount of time, but you should also know that there's so much more to know about investing than we can squeeze into a 10-minute video. So for more about stocks, bonds, investments, taxable brokerage accounts, tax advantage retirement accounts, really anything personal finance related, check out martinmoney.com or the playlist on our YouTube channel. As always, I am grateful for your time and your interest. God bless and take care.